amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second wind.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with a steward's view. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. With your host, Aaron Kolkman, managing partner of Fideer Advisors in Minneapolis. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time with a steward's view. A Steward's View is brought to you by Fideer Advisors, a registered investment advisor. You can listen to this podcast and previous episodes at fideradvice.com. That's FIDERE advice.com. Now here's your host, the managing partner of Fideer Advisors, Aaron Kolkman.
Welcome back to A Steward's View. I'm Aaron Kolkman. So glad you chose to join us again. And you can find this program online at fideradvice.com/podcast. That's FIDERE advice.com/podcast. You can also pick it up on Apple, Spotify, SoundCloud, or YouTube. With that, it's been a big week, and I'd like to give a little bit of a recap in where we've been. Just in this past week, we had Liberation Day, April 2nd, 2025, with major tariff announcements by the Trump administration. And with that, economic outlook revisions have abounded. In fact, they've been mixed. JP Morgan adjusted its economic outlook to include a U.S. recession in 2025. Fund manager Bill Gross gathered attention with his short warning to investors to not try to catch a falling knife. Other economists warned of slowing growth and increased inflation risk, known as stagflation. With jobs, according to the Bureau of Labor Statistics data released Friday, the U.S. economy added a stronger than expected 228,000 jobs in March, increasing from February's gains. The robust gains notched in March were likely a rebound after wildfires and bad weather depressed job growth in January and February. The unemployment rate in March ticked slightly higher to 4.2% from 4.1%, driven up partly by new entrants into the labor market. Economists were expecting job growth to slow to 130,000 in March and for the unemployment rate to tick up to 4.2%, according to FactSet. With the U.S. dollar slumping about 6% against other major currencies, Treasury Secretary Bessent maintained his strong dollar policy. He insists that we have a strong dollar policy and we are putting in all of the necessary ingredients to make sure the dollar is strong over the long run, quote unquote. He added that, quote, the dollar is going to do great, referring to the Trump administration's approach to reordering global trade and the U.S. standing with its trading partners. In the financial markets, the Russell 2000 took another pounding on Friday, tumbling 4.4% to end at 1827.03. Meanwhile, the S&P 500 fell nearly 6% to finish at 5074.08. The large cap index will have to close below 4,915.32 for a bear market to be confirmed. The Dow Jones Industrial Average was off 5.5%, ending at 38,314.86. The blue chip index on Friday officially entered correction territory, defined as a 10% decline from its recent peak. Further, the Magnificent Seven stocks have led major indexes down, while the equal-weighted S&P 500 index dropped significantly less. In other news, the S&P 500 PE ratio and forward PE ratios aligned for the first time in years, with both metrics hovering near 20, indicating the S&P is more accurately valued. In the bond market, the U.S. Treasury yield curve inverted over the past week, with the 10-year Treasury closing April 4th at 4.04, while the 2-year closed at 4.25. These yields represent a slight inversion and are nearly an exact opposite of the yield pattern 2 weeks ago. Lots of changes in the economic picture, lots of changes in the markets, and lots of volatility that we have to navigate. So much to talk about today. I'm really excited to have Chris Gerber, our portfolio advisor at Fideer. Chris is a CFA. He's been 40 years in the industry of finance, that is portfolio management and financial planning. He's been in lots of fascinating and valuable roles in our industry, and he's joining us to talk about what's been happening around us just in the past week. And so I really am I'm so grateful to have him back on the program. We have some published material as well that Chris and I worked on over this weekend. One round out of two has gone out already to investors, and that's available on Fidir's website, fidiradvice.com. And then in the footer, there's a click or a sync where you can go grab the white paper version of A Steward's View. I think there's also a clickable link right on the homepage. So on your phone or tablet or however you get to fidiradvice.com, you can grab the white paper that talks about the counsel that we have to offer you, and that'll be part of what Chris and I are going to go into today. So with that, Chris, welcome back to A Steward's View.
It is a true pleasure to be here on such an important day.
And where do we start?
You know, I was wondering that myself, and I pulled out a stat that might be interesting because it kind of indicates how we got here. And it's a kind of an unusual stat, but it's actually a very valuable one. It has to do with the average age of a car on the U.S. highway. Have you ever heard of this stat before?
A what?
The average age of an automobile on a U.S. road.
No.
Because when you think of it, that is a barometer of the elections and a lot of things that people do, because the question is, can they afford a car and how old and so on. So I pulled up that stat, and the average age as of the start of 2025 of the car on a U.S. road is 12.2 years. Now, that's considered what they call an older fleet. And then I pulled up stats from other countries. For example, Germany, 6.5 years. Poland, of all places, 5.5 years. Singapore, 5.5. China, 5.1 years. Saudi Arabia, as you might guess, 3.8 years. So that tells you, in a sense, a temperature for the average American consumer. Their cars are old, and they're looking for answers. And then this happens. So here we are. How do you like that one?
That is not the angle I imagined you starting with, but I'm so glad that you did. my
It's very pedestrian, really, when you think about it. It's the average everyday. How are we going to eat?
Right.
How are we going to get what we need? How are we going to get to work?
So okay, maybe we can add that to the weekly data readout that we give. You know, the average age of the American car, although it'd probably stay at 12.2 for a really long time.
Probably a fairly long time. Yeah.
So I hesitate to dive too far too fast, but I do want to acknowledge that, you know, looking around, I just look at market activity from last week. Russell 2000 on Friday, April 4th, tumbled 4.4%. S&P 500 fell nearly 6%. The large cap index is near a bear market. Okay, as of Friday close, April 4th. And it's up right now as we speak. So maybe you won't get to a bear market in terms of the technical definition. The Dow Jones was off 5.5%. Okay, so what say you to these major moves? I'm going to bypass a couple of thoughts that I have on purpose, other than the average age of the car in the United States. How can we think about these big moves that are going on with regard to navigating, right? So what are the next steps that you, Chris, would have? Maybe some definition, some context even.
Sure, that would be fine. I'm going to dissect that S&P 500 that you mentioned a little bit, and I want to make sure that people understand that there are 7 stocks that really move that a lot, and they aren't necessarily indicative of 500 stocks by themselves. So the 7 stocks are Apple, Amazon, Alphabet, which is Google, Meta platforms, the old Facebook, Microsoft, NVIDIA, and Tesla. Now, those things are all over the place. They're down a bunch for the year, But while they are down a bunch for the year as of last Friday's close, believe it or not, the remaining 493 stocks on the S&P 500 were actually up on the average over 5%.
That's something.
So diversification really does make a difference. And when you and I talked about putting something together for this, I looked at the history of trade wars because that's what everybody's thinking about right now. And they usually follow a pattern. And we're in the middle of that pattern. And I don't think the average person is used to being in the middle of a pattern like this. Because when we look back at our history, the history of people alive and listening to this right now has been actually pretty good financially. After World War II, we supplied the world. The world was decimated. And we could make a lot of errors in that supply process, and we still rolled in money. And then as time went on, we accumulated some errors, and we're seeing some of the results of those now. We're getting kind of hammered on tariffs, and we shouldn't be. But when we look at where we're at now, in the middle of a turmoil like this, most of us are simply used to going to work every day. And like the old Bachman-Turner Overdrive song where it says you go to work and you get your pay. You go to work, you get your pay. You don't really have to think about being an entrepreneur too much. But as a country, because of some decisions that have accumulated over many, many years regarding our deficit and not going into a status where we are unable to pay that, we're probably at a point where we have to think of some new ideas. And not necessarily that this is the right new idea, but it's a new idea. So here we are in it, okay? Historically, trade wars start with a tariff imposition. Somebody starts a tariff. Right now, the United States is reacting to a whole bunch of tariffs. Now, the United States has tariffs on other countries also, just not nearly to the same effect as theirs, not nearly to the same extent, I should say. Typically, then, you see the step number two is a retaliatory measure. Well, that's what we just did. Now, the question is, will other people retaliate? And they are. So the affected countries typically respond with tariffs of their own, tit for tat. So now we're in the escalation phase, which is phase number three. Both sides raise tariffs, and they might lead to higher prices and strained trade relationships. That can happen. Ultimately, though, typically what happens is there is a step number four, which is a negotiation or a resolution step, where eventually everybody comes to the table somehow and they make agreements, and typically the tariffs reduce. Now, we're not seeing, what I should say, we are not used to this because we don't see this every day. But now we're to the point where it's not a bad idea to do something, whatever it is, because as I look at the deficit information, and that will come out on the next newsletter that you put out, federal finances are in a position where, and I'm looking at them here in my computer screen, our net interest expectation for 2025 from the Congressional Budget Office is 14% of our overall federal budget. Well, that's higher than Medicaid. That's higher than normal mandatory things that they've committed to in Congress that they have to pay. That's higher than defense. That's right up there with what's called non-defense discretionary spending, which is, when you look at all of that, if you saw the categories, you'd recognize most of them. It is still behind Medicare, which is at 16%, but not that far behind. And if things continue the way they are, we are looking by 2035 being in the top 10 in the world for debt as a percentage of our gross domestic product. That's how close we are. So the can has been kicked down the road quite a bit. And right now, our percentage of debt to GDP is about 122%. But when we get into the top 10, by the way, with an estimation of around 130%, that's what the CBO is estimating. We're just behind Italy and just ahead of Bhutan. So that's a top 10 list we don't really want to be on. And our leaders have not come to some solutions for this.
Chris, let's summarize what you just said right after we take a break. I'm fascinated by all of this. I know our listeners will be. If you could pause with me just for a moment, and we'll be right back.
Support Life Crystal Women's Clinic has been empowering women and protecting life since 1992. Their mission is to be the first step for women at risk of aborting their babies, empowering them to choose life through education, practical help, and hope in Jesus Christ. If you want to learn more about Support Life and their life-affirming ministries, please visit supportlife.org. That's supportlife.org.
And we're back. Welcome back to the second half of A Steward View. We're visiting with Chris Gerber, CFA. Chris, I'm just going to add a word here. Senior Portfolio Advisor at Fidir. I am a portfolio manager. I am grateful to have someone as senior as yourself in our industry to add to the perspective, the thinking, the strategies that we run at Fidir. Those models are available online at fidiradvice.com. That's FIDERE advice.com/models. And we're here now talking with Chris about his view of what's happening in terms of the U.S. piece of this picture. And he just got done saying in the second half, and Chris, correct me if I missed something here, but we've got a 14% allocation to interest costs on our outstanding bonds in terms of our overall federal budget. And then you said something related but different, which is we're exceeding our GDP in what? Our GDP is exceeded by
What's going to happen, according to the Congressional Budget Office, by 2035, is that their expectation is that our deficit will enter the 130% range of our GDP.
Got it.
That's big. That puts us in the top 10 worst budget deficits as a percent of GDP of all the countries in the world. We're not that far from it now. In fact, I can tell you where we're at. We're at 122% as of the beginning of 2025.
So maybe when we try to tie these two things together, and the reason I left that open is we say, okay, the federal, and this is important for anybody listening, Chris, to clarify, because this can get really confusing really fast. So you may know, I don't off the top of my head, what the outstanding debt is that the Treasury has. Okay. But the interest due on that debt is the first metric that you mentioned.
Yes.
Right? And the amount or the percentage of our total federal expenses that represents is 14%.
Yes.
Okay.
That's just a little under $1 trillion
so then when
per year that pays interest that just goes away.
Okay, so then when you say, okay, well, we're running a deficit, that's generally known that we're not covering our expenses with income as in terms of the government, right?
Yes.
We're running a deficit. We're spending more than we make as a government. I say we. It is spending more than it makes. Okay, well, that deficit is big enough now that it exceeds GDP by, I don't know. I mean, 1.22 times. You said 122% of GDP, yes?
Yeah, yeah.
Okay. So those are two related comments that both spell concern, right? And this concern, as you pointed out in the first half, has been built up since a series of decades since World War II. So now what?
I like how you asked that.
Well, I mean,
So-
you're here to give counsel. So what is it?
Well, I think I'm going to refer to something I heard Scott Bessent mention. He's our Treasury Secretary. He mentioned over the weekend that we can have a guaranteed catastrophe in just a few years. Absolutely guaranteed, and that's probably right. Or we can start to feel some pain now and try to do something about it. Now, but that's in the context of this pain has been being felt for, I've been in this business for 40 years, and it doesn't seem that the Congress and the president and the Senate have ever really gotten together to do something about this, and they've referred to this as kicking the can down the road. So now we're in a position where something different needs to be done. And right now that different just happens to be a tariff. And it's a retaliatory tariff on things that have been tariffed in the past. Now, we have run tariffs on other countries also. And it gets back to that original 4-step, this is how tariffs usually work thing that I talked about at the very beginning. Now, in the midst of all of that, consumer finances, and just so people know, generally they're not bad, but some things are ticking up. For example, debt payments as a percent of disposable income, they are tipping up in a way that we don't like to see. So that gets back to that first comment on the average life of a car or the average age of a car on the highway right now. And after falling after the pandemic, delinquencies on homes and mortgages and other debts have been steadily rising and are now above pre-pandemic levels for auto loans, credit cards, and mortgages. So we got a few things percolating going on that we see are tough. Now, where does that actually take us? I'm going to kind of jump to the very end, because when I look at things like inflation, which I'm not really worried about right now, especially if we do go into a recession. And a recession is typically, it has historically been about a 1.5% back-to-back decline over 2 years or over 2 quarters in GDP. And that could happen from this whole thing. Jobs, our unemployment rate is very, very low. Profits last year were phenomenal. They were outstanding. So it's not like we're coming at this from a horrible backdrop, just a percolating backdrop. And overall, I think the conclusion for this, Aaron, is the financial landscape is in pretty good shape. And I think that essentially people have to understand that diversification is absolutely necessary. Just like it was at the start of the year, just like it was last year or 5 years ago. Do they have a portfolio that is balanced in terms of risk and expected return for where they are at in their life cycle, or have they drifted away from that balance? So one of the important things would be maybe this is a time to, not maybe, for sure, it's a time to rebalance portfolios. Things have moved wildly. Even after the last few days, are they still too concentrated in overvalued securities? Now, that's a hard one to get away from because of that magnificent 7 that we discussed before, if they're in an index of any kind. Okay, so do they have a truly global diversification, or is it just in the US? Are they split between value and fixed income and growth equities, international and alternatives even? This is a time that I would say is no time for exceeding bravery when it comes to tactical moves. It's a good time to be prudent and reassess your allocations. And it is also a good time to say, if I'm out of whack on something, I need to get back in, but understand that this so far is by no means the worst thing that we've gone through in your and my lifetime in this market. It sounds like it is because when you get in the car today, you're going to turn on the radio and you're going to hear about all this stuff, like for the, 12,000th time. Can it get really bad? Technically, it can. I'm actually very optimistic that it won't, because what we are hurting from it, overseas, they're hurting even more, because we're the shopping mall for the world here. When the tough gets going, the U.S. citizen goes shopping, right? That's what happens here. And we are the biggest marketplace by far of anybody in the world. And so we do have some cards to play. And that's explained a little bit on one of the newsletters that goes out, that will be going out. But I have a stat here. The consumer spending portion of our total GDP is about 68%. And that represents about a $30 billion in 2024 size of consumer spending. That's a lot of spending. The next closest was China at about 20 billion. Then it drops off a cliff down to Germany at about 5 billion. So we are still the biggest shopping mall in the world, which gives us some power. The question, maybe this shakes up some people to say, hey, Congress, we have to start fixing some of this internally. And maybe we can come to some conclusions with our trading partners on how we proceed together. And I'm going to caution investors on something too, because they're going to hear economists reference average tariffs. Our average tariff before this started was 2.5% that we were charging. The average tariff we were paying is 5%. That's nice. And economists will reference that. But that is not the important stat, because tariffs are oftentimes targeted to destroy industries. For example, our manufacturing industry is pretty low compared to what it was when I came out of college. And so it's not just averages, it's targeting. And that's what we have to get around. We have to have a fair playing field. And I don't know if that can even come close to being accomplished now. Chances are not. But in the meantime, people who are well diversified, who are thinking in terms of where they have to be, who have a reasonable amount of risk in their portfolio, and you have several portfolios with varying risks, they should do fine, because the world will go on. People will still trade. The place isn't going to explode because trade doesn't become free. Maybe it becomes closer to free as a result of this. But also maybe it's a wake-up call to our leaders to say, we got to fix our own debt problem, which would be nice.
Interesting. So there's so much interconnectivity between your comments about trading and the tariff process that you described in the first half, and consumer behavior, and then the national or federal spending dilemma that we have as to interest costs and deficit spending. So there's so much interconnectedness in those things. There's more that I'd like to say. We don't have the time for me to say it, so I'll just say thank you, Chris Gerber. It's been so nice to have you on the program. And for our listeners, again, we've been talking with Chris Gerber, CFA from Fidera Advisors. You can find him online at fideraadvice.com/Gerber. That's Gerber. And Chris, we thank you again for coming on the program. It's been so good to have you, and I know we'll have you back in the near future.
It's been a pleasure.
And looking at the week ahead, on Wednesday, we have wholesale inventories and the Federal Open Market Committee meeting minutes. Thursday, we get initial jobless claims as well as the CPI inflation report. For CPI, estimates are for the headline number to grow at 0.1% and core to grow at 0.3%. Then on Friday, we close the week with PPI data and April preliminary University of Michigan sentiment data. I do hope this program has been a benefit to you and others you choose to share it with. From all of us at A Steward's View, we look forward to joining you next week. And until then, please do be wise and decide well.
You've been listening to A Steward's View with your host, Aaron Kolkman, Managing Partner of Fidera Advisors. To learn more about Fidera Advisors or speak with Aaron, visit fideraadvice.com. That's FIDERE advice.com. While there, you can also enjoy the free Fusion platform for portfolio aggregation. Just click Fusion at the top of the page. To listen to this and other episodes of A Steward's View, visit the website Fidere Advice and click on A Steward's View podcast link at the top of the page. Fidere Advisors is a privately owned full-service life planning firm offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plans for families it serves. Fidere maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidere and its representatives do not offer tax or legal advice through Fidere. Please consult the appropriate advisor. Fidere Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidere, please visit fidereadvice.com. That's FIDERE advice.com.